Number 1. The shift in investment focus from early stage to established companies. When interest rates rise, investors like venture capitalists or VCs prefer established companies with a proven track record of revenue and profitability. They want to be sure that they will get their money back. So startups that are just starting out or early stage startups may find it harder to get funding, as VCs prioritize more successful companies in this case. Number 2. Investor risk aversion. From high risk to safer options. Risk aversion simply means playing safe with your money. When interest rates are low, investors are more willing to take chances on higher risk investments, such as startups. However, when interest rates rise, investors may become more risk averse and prefer safer investment options with guaranteed returns like bonds and other fixed income securities. As a result, startup companies face increased competition for funding, as they need to compete with these safer investment options to attract potential investors. Number 3. Lower valuation. Rising interest rates can impact how investors value startups. A key factor in valuing a startup company is its potential for future growth and profitability. When interest rates increase, it can raise the discount rate used to calculate the present value of a startup's future cash flows. A higher discount rate means that the future cash flows are less valuable today, potentially leading to a lower valuation for the company. This can make it more challenging for the startup to negotiate favorable terms with investors during fundraising rounds, as investors might be more cautious about the company's future growth prospects. One small request before we move further. If you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. Number 4. Longer time to exit. Startups usually aim to be acquired by larger companies or go public through an IPO in order to provide returns to their investors. But when interest rates are high, potential buyers or public market investors may not be willing to pay a premium for the startup company. This reluctance to pay a premium could make it harder for startups to find an exit at a desirable valuation. As a result, it may take longer for investors to see a return on their investment. Number 5. Impact on consumer spending. Rising interest rates can also influence consumer behavior. When borrowing costs are higher, consumers tend to be more cautious with their spending, especially on non-essential items. This decrease in consumer spending can have a direct impact on startups that rely on consumer demand for their products or services. It may result in reduced revenue growth and profitability, making it more difficult for startups to attract investment. Number 6. Sector-specific impacts. Certain industries are more sensitive to rising interest rates, particularly those that rely heavily on debt financing. For example, startups in the real estate sector often depend on loans to finance property purchases. When interest rates rise, the cost of borrowing increases, making it more challenging for the potential buyers to afford home loans. This reduces demand for properties and impacts the growth and viability of real estate related startups. Similarly, other industries that rely heavily on debt to fund their operations may also face challenges in accessing affordable capital during periods of rising interest rates. Number 7. Economic downturn or recession. Significant and rapid increase in interest rates can potentially lead to an economic downturn or recession. During such periods, investors become more cautious and risk-averse, making it extremely challenging for startups to secure funding. So the overall economic climate plays a crucial role in the availability of capital for startups. Now it's time to conclude today's topic. So in summary, rising interest rates can make it harder for startups to get funding and achieve their goals. Investors become more cautious, borrowing money becomes more expensive, and startups face increased competition for limited funding. So it's important for these companies to adapt and find alternative ways to finance their growth during times of rising interest rates. That's all for now, and please feel free to leave any questions or comments below. Thanks a lot for your time, and let's take care of this beautiful world. I'll see you next. And smile. Always smile.